Hi, I'm Max Keiser. Welcome to the Keiser Report. Crash is the new black. You got your hack crashes, your gold crashes, your crashes. Crash is the new thing. It's the in thing. Stacy.
Max, crash is so this season. You should try some. The first headline, tweet from hacked AP Twitter account causes Dow to drop 150 points. Now, we all know this was the AP tweeted out that the White House, there were 2 explosions at the White House and Obama was injured. In fact, it was a hacked AP Twitter account that sent this out. And then the headline from that reads, from a Twitter hack to the complete evaporation of all market liquidity in one chart. The chart here is from NYSE, and it shows the 150-point plunge, but you see no liquidity.
Right, well, that's exactly right, Stacy Herbert, because these markets are essentially a hologram. They're a hologram that is concocted with algorithms that are injected into the protoplasm that is pseudo-liquidity, called New York Stock Exchange and all related contingencies, markets, tangential markets, derivative markets. And it's riding on the edge of an event horizon called probability of 100% that this is going to blow. There is no underlying liquidity. People say derivatives add liquidity. That's a falsehood. People say market making, as iterated by, as defined by Lloyd Blankfein or Jamie Dimon, that's a lie. These markets are nothing but a shadow of a chimera, of a hologram, and they're going to blow.
And the other thing that CNBC noted here was that it's not so much that the computers initiated trades. What happened is that they canceled the orders, so the bids came out of the market. That caused the crash. And you see, when in that chart, there was 0 volume, not a single participant. So it looked like genuinely 100% of the market is by algorithms who are reading Twitter, where half of the tweets are fake anyway, or hacked tweets.
Well, the volume is fake. And I know from the technology I invented, the virtual specialist technology, that the shadow banking system that's run by Wall Street banks and the City of London banks, you put into the system, I call it the ghost trader. That's how it's defined in the patent. But they call it shadow banking system. They just flood the market maker, the guy, the price discovery mechanism, with 10, 20, 50, 100, 200 times normal daily volume as a way to create a price that you want. Remember, Goldman Sachs, they pick a price they want, and then they flood the market volume to get to that price. That's how they manipulate these markets. Now, when there's a rumor on Twitter, and suddenly the shadow banking system, or the ghost trader, as I defined it back in the early 90s, it simply cancels that side of the transaction, and you have the trapdoors open. And I used to do this all the time. This is why in Hollywood, I remember I had a discussion with Disney, for example. They were trying to get me to get the price of their movies at a certain level as part of their propaganda techniques. But here on Wall Street, you simply create prices that are part of an agenda, but has nothing to do with free market capitalism. It has nothing to do with price discovery. It has nothing to do with economics. This is Stalinism. This is Stalinism that's traded every single day, and it's called New York Stock Exchange.
Well, speaking of Stalinism, let's move to the gold crash story. The headline from Business Insider's Joe Wiesenthal, a paper bug as you call him, the gold collapse is great news. Now, he notes with great glee about how gleeful all the anti-gold people were on Twitter. And it was like a pack of hyenas, very happy when on April 12th, Friday, April 12th, the markets crashed, the gold markets crashed. And he said, why is this good news? Well, gold bugs are frequently jerks, and this vindicates the economic ideas of the economic elites. So he's saying that, you know, these economic elites are trying to take care of us. And to respond to the economic crisis, economists and mainstream policymakers have favored highly unusual policy measures, massive Fed balance sheet expansion, massive stimulus, etc. These ideas are usually based on years of traditional economic research, Keynesianism, monetarism, etc. And he's saying it was gold bugs that was ruining it for the likes of these monetarists and Keynesiasts and all these experiments.
Right. Joe Wiesenthal over there at Business Insider, along with Henry Blodgett, they worship personalities. whether it's Bernanke or Paul Krugman, they hate markets. They hate price discovery. They hate capitalism. Notice during this Twitter crash, flash crash, gold price stayed rock solid because it has intrinsic value. Whereas Apple stock, it could be 700 one day, 400 the next day. There's no real intrinsic value of Apple. They've got a lot of cash on the balance sheet. They have a few gadgets that people like. But that could easily go to zero, like Enron goes to zero, WorldCom goes to zero. JP Morgan could easily go to zero. Whereas gold is never going to go to zero, and it performed beautifully during this controlled demolition by paper bugs like Joe Wiesenthal, a Stalinist paper bug terrorist, who needs to be really constrained in some way because his propaganda is destroying the American economy.
Well, it's a battle between, we're at a point where that system is falling apart. So it makes sense that they're trying to justify everything and look for a reason to continue to have hope in it. The gold price is, it's not so much intrinsic value, it's our subjective value. We're viewing it with our human consciousness is saying, well, there's no counterparty risk there. There's no risk of being defrauded by Lloyd Blankfein or Jamie Dimon. They're not going to be able to take it unless they come into my yard and dig up it out of my backyard.
Well, let me just jump in there for a second, because the average lifespan of a paper fiat currency is less than 50 years.
Yeah.
Going back hundreds of years, every single paper currency has become extinct. The average lifespan is less than 50 years. During that time, during that hundreds of years, during those thousands of years, nobody has ever turned down gold as money. Gold has always been money.
Yeah.
So to say whether the intrinsic value is subjective or objective, or it's a debate, or it's a Keynesian, or it's a this school or that school, it's completely outside the main consideration here, which is that paper money has always become worthless. There's never been an exception. Gold has always been money. That's never been an exception.
Okay, now turning back to this, his joy at the crash of gold and why it's good. It's all about perception, and he doesn't even really recognize that. He says, so the collapse in gold is not about gold, but about vindication for a large corpus of belief and economic research, which has largely panned out. It's great that our economic elites know what they're talking about and have the tools at their disposal to address crises without creating some new catastrophe.
Well, what Joe Wiesenthal fails to point out is that while his paper bug brethren were crashing the paper price of gold, the price of physical gold and the demand for physical gold has never been higher in history. The demand for physical gold has never been higher in history, Joe. But of course, he doesn't look at demand and supply. That would be economics. He looks at algorithms and the puffs of smoke that come out of the Federal Reserve System, because he worships the Pope of fraud, Ben Bernanke, because he's a Stalinist idiot.
So let's look at some of what the mainstream financial media was looking at those days, those very days, April 12th, Friday, April 12th, Monday, April 15th. Let's see. And here's Joe Wiesenthal mocking anybody who thinks that there could be anything unusual happening in the gold market. Amid gold slaughter, the $1,300 and even $1,200 marks are lines in the sand. It's a slaughter, says Karsten Fritsch, senior commodity analyst at Commerzbank. It all comes via the futures market. On Friday, more than 1,100 tons of paper gold had been traded. That is more than annual gold demand from China or India. I can't see a fundamental reason for this, to be honest. So here he is saying, this is a guy looking at it on a fundamental reason. He's never seen 1,100 tons of paper gold dumped on the market at one time. Now put that into comparison of the Washington Agreement, where central banks, which hold most of the physical gold in the world, agreed to offload some of their gold, but 500 tons a year over very carefully, to not impact the price. So here's in one day, 1,100 tons.
Look, remember, Joe is a dangerous, duplicitous ideologue. Just 6 months ago, he was recommending that a creation of a magical $1 trillion platinum coin.
Yes.
If you look this up, Joe Wiesenthal believed that you could create a magical $1 trillion platinum coin to rectify America's deficits. This is what Joe believes. Joe Wiesenthal's soapbox is in a very limited area of a few weird paper bugs in New York. He doesn't, no one around in the world, in countries elsewhere, know Joe Wiesenthal from Joe, the weasel, who is terrorizing their garden. And this show, however, goes out to tens of millions of people every single week in Russia, in India, in China, around the world, in America. They understand what I'm saying, that to keep buying gold to destroy Joe Wiesenthal and the banksters. Gold is now trading higher than the paper price, the physical price. That's all you need to know, that the Joe Wiesenthal's and the Henry Blodgetts and the Ben Bernankes and the Paul Krugman are being destroyed. Thank goodness.
So then going back to this article from MarketWatch, where they're looking at the actual action happen live in the markets, April 12th, Friday, April 12th, at Sharps Pickley, CEO Ross Norman said 3.4 million ounces of gold, or 100 tons, hit New York's market on Friday at the open. That was only the start in a shock and awe campaign that had all the hallmarks of a concerted short sale.
No, it triggered a buying stampede.
Yeah.
As we told everyone in the world that it would, and they're happily buying gold. And also miners, they're not making money at gold at these levels, so they're shutting down. Oh, what's that going to do to the supply of gold? I guess it reduces it. The demand is high. Let's see, high demand, lower supply. Let's see, Joe, can you figure out what would happen to the price in that case? It's called supply and demand. It's called economics. You better ask Ben Bernanke, because you can't figure that out. You're too freaking stupid to figure out what a demand and supply curve looks like. Quick, what does Paul Krugman say? I have to go to the toilet, and what do I do? Do I wipe my? Do I wash my hands first? I'm confused. I'm just a stupid New York idiot, paper bug, nincompoop. Paul Krugman, help me!
So Ross Norman at Sharps Pickley said that there was a concerted short sale going on. So we're going to look at what a concerted short sale, how that could possibly be used to intentionally cause the price to go down. Joe Wiesenthal says that's a conspiracy theory and it's wacky. Now we're going to turn to a little clip from a film from CBC in Canada. They did a documentary this week about the secret world of gold. And in it, there was a scene with Bart Chilton, a CFTC executive, where he is investigating gold and silver manipulation. And this is how he explains it happens.
What we've seen all too often is where you have an individual trader who has excessive concentration. And when I say excessive, I mean concentration that can lead to pushing prices around. And we've seen it in precious metals, in silver, in gold, and in some of the other commodities.
So Bart Chilton, a CFTC regulator, admits that there's concentrated positions in market manipulation, but he can't do anything about it because he's just waving his blonde hair and shaking his breasts for the TV cameras, and he's completely ineffectual as a regulator. All right, now after the break, I'm going to be talking to Andrew McGuire about this in depth, but Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Andrew McGuire coming right up. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to precious metals expert and whistleblower Andrew McGuire. Andrew, welcome to the Keiser Report.
It's great to be here, Max. Nice to see you.
Yeah, it's great to have you on. Now, Andrew McGuire, you say that a gold default is underway as we speak and that this is the reason for the recent gold smash. So first of all, what do you mean by gold default, so people understand what that means?
Okay, so basically what I'm saying is that if you are a holder of bullion and you think you own that bullion and you just happen to turn up and ask for that bullion and you're told, I'm sorry, we don't have that bullion, so will you take cash instead? In fact, you're going to take cash instead. Well, technically that's a default. Now, you know, under the unallocated LBMA system, technically, if you read through the small print, yeah, you can be settled for cash. However, that's not what most people think.
Okay, the LBMA, people have seen you and others, part of the recent lawsuit that's been waged against banks for manipulating the price of silver. And what came out was that the LBMA is leveraged 100 to 1 in some cases on their precious metal positions. So here's an exchange that is even more leveraged than Enron was at the height of its before it collapsed, before WorldCom collapsed. Here's 100 to 1 leverage. So every dollar of physical, they've got 100 of paper. And so when people go to take delivery of that gold and silver, they're said, no, we have to get paper instead, number one. Number two, there's a real threat that it could cause a run on the exchange, and now this leads to the recent smash because people were demanding their precious metal, and then this leads to the recent smash. Talk about it.
Yeah, that's exactly right. I think what the straw that broke the camel's back was the Cyprus issue. Now, I had a very large client come to me and say, I'm getting my physical. So he went, this is part of the ABM AMRO story. So he went, and this was before even the letter was sent out to all their clients. And he went and asked for his bullion back, and was told, well, no, we've got to settle you for cash. But hang on a minute, you know, this is my bullion. Now, you know, reading the small print, you don't actually have a numbered bar. But you actually believe, when you go and apply for a bullion account with a bullion bank that's part of the LBMA system, you are told, here, you've got two choices. It's much cheaper to go this route. You don't actually get a numbered bar, but essentially that's your gold. Otherwise you wouldn't buy it in the first place. Or go the allocated route, it's going to cost you a lot more money. You get a numbered bar, but why incur the cost?
All right, so people are not able to take delivery of their gold. I was just reading Jim Sinclair was talking about a client or a friend of his who was having the same problem in Switzerland. So in Switzerland, they went to get his gold, and they're saying, wait a minute, there's no gold here. We're going to settle for paper. Now, let's talk about the paper gold market for a second, because there's a big paper gold vehicle, GLD. It trades on the stock exchange, but that's not real gold, is it? It's really paper gold. And there was, as part of these maneuvers to smash the price, of course, you have the futures market that gets smashed with naked short sales in a lot of cases, but these ETFs are also smashed. But when you buy an ETF like GLD, you're not buying physical gold, are you?
Well, no, you're ending up with shares and a claim on gold. That's what. Look, essentially, there's only two things. You either got something in your hand you can clunk, or it's paper. I don't trust the latter. And obviously, when we saw this recent short smash, you notice that Goldman Sachs, when they came out and issued the sell short note, which was just before the federal intervention came in, they started by shorting GLD. Very interesting, because you get a lot of leverage that way. Forces, obviously, the redemptions force the bullion to be purchased. But it also, if you think about it, none of this bullion in all of this smash, not 1 ounce of that bullion has turned up. There is no physical for sale. So, where is it going? Well, I suggest strongly that it's going to replace inventories that were not there in the first place. All these inventories are mismatched by duration, and it's incurred itself over the years. You've had basically all the way back from the lease carry trade. So you've had bullion banks building up index positions, never really needing to purchase the gold, and all of a sudden you get someone like China, like Russia, like central banks and sovereigns, and other smart investors saying, look, I tell you what, MFG didn't like what happened there, rehypothecated gold. No, I think I'll better take delivery. So now you've got this enormous pressure on the bullion that was never anticipated in the first place. So when they originally took your $10 million from the pension fund and decided, well, let's not buy bullion, let's just give you a receipt, and now we're indexed to the price of gold. Obviously, number one, by not buying the gold, it didn't go up. Number two, now you've got an incentive not for price not to go, the price of gold not to go up. So obviously, suddenly, more than 3 or 4 people coming for their ounce of gold, 100 to 1, is going to cause a problem.
Right. Now, Andrew McGuire, you've been a pivotal figure in the scandal, really, that is the gold market and silver market. This is something that's been covered by the Gold Antitrust Action Committee for years. People have been writing about it, and they've been on the margins. And then as the price has gone higher, and this outcry toward what appears to be manipulation has grown over the years, and then you actually sat down with a regulator and said, look, here's where the price is going to be manipulated. The price is going to crash at this moment. This is, and you basically explained a manipulation before it was going to be manipulated. It did exactly what you said it was going to do. The regulator looked at that and they said, wow, that's interesting, let's investigate. They did an investigation. Where is that now?
Right. Okay. It's ongoing.
You showed them the smoking gun. You
yes,
showed them the manipulation. You said, here's where it's going to happen. There's a great video out there. You said, it's going to crash right here because they're manipulating it right at this price. You showed them the smoking gun, the evidence. So what happened?
Yeah, exactly. Well, we're still ongoing. Now, the thing is that, and obviously, there are things I really wish I could discuss, but there is an active investigation going on. It covers more than one country. And so obviously, there's not a lot of comment I can make about that, but other than they were definitely given sufficient evidence to be able to pursue that investigation further. There is also new evidence coming in all the time. What I will say is this recent documentary that came out, as much as
the Canadian
documentary that came out.
It was called, we talked about it in the first half of the show, incredible
secret world of gold.
That's it, secret world of gold.
Yeah, which I mean, obviously for people so close to the gold market, they're a little disappointed there wasn't more about manipulation in there. But generally speaking, at least what it did was perhaps educate millions of people around the world on the History Channel, various countries. My God, if I've got any gold, I want it. So really, you're actually educating people. Then those bankers can't be trusted.
So Andrew, what about this idea of cognitive dissonance? Because we know for a fact now that the major banks, the same billion banks who operate as non-billion banks, I mean, they rigged the LIBOR market, multi-$100 trillion LIBOR rigging. Yep. They admit it. They paid a fine. They showed that, yes, we do it. We pari passu with rigging LIBOR, if you're going to keep interest rates manipulated and currencies manipulated, you would have to, by definition, also manipulate gold and silver.
Absolutely.
Right? Otherwise, because why manipulate LIBOR and then have gold and silver skyrocket?
Well,
right?
What people fail to remember, when you see people talking about gold and silver as commodities, they are actually currencies. And people forget that they actually trade as a foreign exchange cross. So when you go long gold, you are shorting the dollar.
So why is it so difficult for people to understand that gold and silver are being manipulated just like LIBOR?
It's just amazing to me. It just absolutely staggers me.
Okay, let me ask you this then. The markets, as you've described it and others, are at a major inflection point because there's a run on gold and silver. The price smash by the paper cartel has only increased demand.
Yeah.
And as a result, these futures exchanges are being overwhelmed.
Yeah, they are.
They can smash the price. Now, every time they do smash the price, the unintended consequence is they're increasing demand almost exponentially. So the people in India, Russia, China, who are out there queuing up around the block to buy gold, are they ultimately going to smash these bullion banks and the paper cartel? Is that the hope of the world is in the hands of the people queuing in Bangkok to buy gold bullion, to decimate HSBC, Barclays, and these what I call financial paper terrorists? Is that, how close are we now in your thought?
And what we're seeing is, and obviously the visible side is the retail side. You're seeing an insatiable demand, people losing faith in currencies and buying physical. Where it's crossing the line is into the wholesale market. And I think that is the key. It's the wholesale market that is now short in supply. And that is what we ran into very recently, 3 weeks ago, when ABN AMRO issued that very first written default of an LBN.
Can you review that for the folks, because this was a major turning point. Just describe that briefly to give the background there. If you can.
Well, obviously, I mentioned I had a client that went in there to ask for a physical. He was refused. They must have been having a lot of other requests because a letter came out within a day or two to all their clients saying they no longer could receive their bullion in cash. Well, that is a major smoke signal, and I couldn't believe that none of the financial press picked that up. I mean, that is a crack in the dam. Then you conversely look over to the COMEX and see a 90-day reduction, incredible reduction in inventories. And you suddenly see there's every reason in the world, either one of two things is going to happen. The bullion banks have to buy back their gold, which drives the price through the roof, or you're going to have to default.
Okay, let's take the example of bullion banks default,
Yeah.
or COMEX defaults, or LBMA defaults.
Yeah.
Will the central planners, the central bankers, the commercial banks, will they step in and bail them out with more paper? That's the question people always hear. They say, well, they can never default because they're tied at the hip to the central banks, and they'll always just bail them out. Your thoughts?
Well, all they're going to do, and I'm sure, Max, you've covered this before, they're going to hit a keystroke, they're going to print some money, they're going to settle people in cash, the price will gap up, you'll be settled in cash on the day before, and the price will start to find its true level. You will not be on board for all the years that you've intended to hedge yourself. You'll have lost that instantly.
Right. People buy physical gold against the inflation of the paper money supply.
Yeah.
So the fact that they're going to try to save the markets by increasing the money supply is not a reason not to buy gold. It's the opposite. It's the reason to buy gold. Now, Ben Davies, who is a friend of the show, and he's a gold manager as well, he made an interesting comment that gold will go to $5,000 an ounce, but nobody will own it. Yeah. I think, because they're scaring people out of gold, and then there's going to be a default, as I understand Ben's comments, and then you'll see a gap opening to $5,000 an ounce, but by then, if you don't own any at that point, it's too late.
If you don't own any physical, that's the key, of course, is you've got to own the physical. Anyone who's margined to be honest, I really have no sympathy for people who over-margin themselves. If you're a margin, you better hedge yourself. But the point is that, yes, he's right. Of course, gold is going to find its true level. We don't even know what that is. It's been suppressed for so many years. But certainly one thing for sure, you've got China, Russia, as you mentioned, these other countries, now looking to back their own currencies with a reserve of gold. So that makes their currencies, and I think the IMF issued a statement that within 3 to 5 years, China is going to be the world's reserve currency.
Andrew Maguire, we're out of time. Thanks so much for being on the Keiser Report.
It's great to be here, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Andrew Maguire. If you'd like to send us an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all. Herbert, because these markets are essentially a hologram. They're a hologram that is concocted with algorithms that are injected into the protoplasm that is pseudo-liquidity, called New York Stock Exchange and all related contingencies, markets, tangential markets, derivative markets. And it's riding on the edge of an event horizon called probability of 100% that this is going to blow. There is no underlying liquidity. People say derivatives add liquidity. That's a falsehood. People say market making, as iterated as defined by Lloyd Blankfein or Jamie Dimon, that's a lie. These markets are nothing but a shadow of a chimera, of a hologram, and they're going to blow.
And the other thing that CNBC noted...
Single day, and it's called New York Stock Exchange.
Well, speaking of Stalinism, let's move to the gold crash story. The headline from Business Insider's Joe Wiesenthal, a paper bug, as you call him, "The gold collapse is great news." Now, he notes with great glee about how gleeful all the anti-gold people were on Twitter. And it was like a pack of hyenas, very happy when on April 12th, Friday, April 12th, the markets crashed, the gold markets crashed. And he said, why is this good news? Well, gold bugs are frequently jerks, and this vindicates the economic ideas of the economic elites. So he's saying that, you know, these economic elites are trying to take care of us. And to respond to the economic crisis, economists and mainstream policymakers have favored highly unusual policy measures, massive Fed balance sheet...
50, 100, 200 times normal daily volume as a way to create a price that you want. Remember, Goldman Sachs, they pick a price they want, and then they flood the market volume to get to that price. That's how they manipulate these markets. Now, when there's a rumor on Twitter, and suddenly the shadow banking system, or the ghost trader, as I defined it back in the early 90s, it simply cancels that side of the transaction, and you have the trapdoors open. And I used to do this all the time. This is why in Hollywood, I remember I had a discussion with Disney, for example. They were trying to get me to get the price of their movies at a certain level as part of their propaganda techniques. But here on Wall Street, you simply create prices that are part of an agenda, but has nothing to do with free market capitalism. It has nothing to do with price discovery. It has nothing to do with economics. This is Stalinism. This is Stalinism that's traded every...
Here was that it's not so much that the computers initiated trades. What happened is that they canceled the orders, so the bids came out of the market. That caused the crash. And you see, when in that chart, there was zero volume, not a single participant. So it looked like genuinely 100% of the market is by algorithms who are reading Twitter, where half of the tweets are fake anyway, or hacked tweets.
Well, the volume is fake. And I know from the technology I invented, the virtual specialist technology, that the shadow banking system that's run by Wall Street banks and the City of London banks, you put into the system, I call it the ghost trader. That's how it's defined in the patent. But they call it shadow banking system. They just flood the market maker, the guy, the price discovery mechanism with 10, 20, 50. Hi, I'm Max Keiser. Welcome to the Keiser Report. Crash is the new black. You got your hack crashes, your gold crashes, your crash crashes. Crash is the new thing. It's the in thing. Stacy.
Max crashes so this season. You should try some. The first headline, tweet from hacked AP Twitter account causes Dow to drop 150 points. Now, we all know this was the AP tweeted out that the White House, there were 2 explosions at the White House and Obama was injured. In fact, it was a hacked AP Twitter account that sent this out. And then the headline from that reads, from a Twitter hack to the complete evaporation of all market liquidity in one chart. The chart here is from NYSE, and it shows the 150-point plunge, but you see no liquidity.
Right, well, that's exactly right, Stacy.